Gents, welcome back. We did this on 14th of July. We had a lot of fun then. We had a ton of material that we had prepared. We got 15 minutes in. We were like, we have great questions. So why don't we get straight into the questions? So in light of that, I guess we decided, instead of us preparing a bunch of content and just talking, at the audience, we decided to take some questions in. And we had some really, really good questions come through as I checked 5 minutes before this started. So um, I'm excited to get into them. I think a lot of them will cover a broad spectrum of, I guess, topics. There's a lot of stuff for you, Roger. So I hope you've come prepared, talking about structures. Ash, there's some great questions around lending as well, and of course, there's the broader questions around the market, which I'll be happy to sort of step into. But I think across the three of us, the audience should hopefully be in good hands to be able to get through. I think there's about 8 or 9 questions. What do you both think? Do you guys want to do a quick intro, just for if anyone that's new in sort of as part of the audience, who would like to do a quick sort of intro around the board? Maybe Roger, start with you.
Yeah, cool. Hey, I'm Roger Fredrick from Trident Financial Group. I'm one of the partners here. We run an accounting and tax and advisory business. That's our core business, and we help clients that are business owners, investors, property investors, individuals, self-managed super funds, so all of the above when it comes to holistic accounting, tax and structuring, and love what I do and happy to be of service. So ask the questions, happy to be of service.
Beautiful. Thank you, Roger. Ash?
That's awesome. Chowdhry, good to be on this again. Can't believe it's been 4 weeks. So I'm the founder of Embark Financial. We're a full service brokerage, but our primary segment is definitely property investors. So yeah, now looking forward to another awesome session. And yeah, thank you again, everyone who's joined in and sent those questions. So looking forward to it.
Beautiful. And I'm Addy. I'm part of the team here at Alaya Property. We're a buyer's agency. We primarily help property investors across the country. And yeah, it's an exciting time. There's a lot of things that have changed in the market, especially I like to think of it life before 12th of May and life after 12th of May. I think a lot of things have changed. A lot of things have impacted the property market as a whole. I think 5 minutes before we joined, we were talking about the broader market, what the downturn has looked like. Is it going to continue? Is there going to be, other movements in the market? But we also have a really good and exciting announcement, at least for the nerds in us, around the RBA keeping the rates what they are, which is exciting. So hopefully contributing to a bit of a sentiment change, or at least sentiment keeping level versus what it's been like for the last 3 or 4 months. So yeah, look, I'm really excited to do this. I think we got a lot out of. Even I learned a ton a month ago when I was sitting down with you gents. I learned a ton about lending, learned a ton about structuring as well. And I think the questions that have come through are in light of that. And I think people are really just really keen to understand what is the best way for them to move forward in this new world, and how should they be approaching property investing? Has anything changed really? Maybe that's the broad thing. Has anything really changed when it comes to lending and structuring post May the 12th? And I think a lot of the questions come with that sort of inspiration in mind. And I actually really love the fact that so many people are still so keen to contribute towards their long-term future, right? Long-term goals, future, medium-term goals. I love that people are not be like, okay, property investing is done. There is no sort of headline thing, be like, oh, property investing is done, investing is done. This is not the thing to do anymore. But there's also some really, really, intelligent questions around okay, it's not done. What do we need to do to pivot and, make the best of the situation that we're in? So very, very exciting. I'm happy to kick off some of the questions that have come through, and then we can sort of take it from there. Yeah, are you guys okay with that? And maybe we can just sort of rotate around who we pass the questions to. So I've got the questions sitting here. I will put Roger in the hot seat because it sounds a lot like a Roger question to begin with. So Will Carr asked a really great questions. Actually, there's probably more of even like an Ash thing. If I was to have 3 investment properties under personal brackets, joint names, and serviceability is capped, is it possible to buy the next few properties in a company structure or a trust structure? Can you explain the process a little bit? For context, joint salary is around 250K, both PAYG. Really, really good question. I'll hand over to one of you boys. Maybe Ash, you can lead the conversation on that one, and then we can go into Roger.
Yeah, no, it's a really good question, Will, and thanks for sending that through. So I think, look, if you've got 3 investment properties in your personal name and your serviceability and your borrowing capacity is capped, I would suggest, obviously, as an obvious answer, the first thing is just do a proper assessment with your broker. So, find out if there's any opportunities for you to essentially do a bit of optimization with your portfolio, do a bit of an audit. Because I think the first thing you want to do is to be able to squeeze anything and everything that you can from your borrowing capacity and your servicing, right? So I think I'd probably just say that as a general point anyway, just to make sure you can get that assessed. Look at your terms, if there's anything that's principal interest only, etc. You want the best interest rates. Any and every opportunity where you can squeeze more borrowing capacity is really important, because from a process point of view, and again, Roger will talk to the actual structures and the pros and cons and that sort of stuff. But from a process point of view, when you and if you buy in a company or a trust, the assessment, especially if it's going to be your first one, the servicing assessment is essentially still going to be the same thing. So the income, your liabilities, your debts are essentially just going to be what you have at the moment, right? Your personal debt, your personal income, because you're going to be providing a guarantee, a servicing guarantee. So this is where, and we kind of touched on this last time in our last webinar as well, having that sort of forward planning, that strategic planning, having that strong team, your broker, accountant, buyer's agent, everyone kind of working together and formulating a bit of a roadmap is so important, and even more important now. So I think if you have that excess capacity, borrowing capacity, that is essentially what's going to allow you to buy in the trust as well, right? Because again, that's the borrowing capacity that you need. But from a process point of view, it's pretty straightforward. As you might know, with trust lending now, the lender pool is definitely shrunk. So we just have to be mindful of that. You probably don't have as much flexibility when it comes to, the upfront contribution aspect of it as well. You'll be looking at a slightly higher upfront contribution when it comes to trust. But from a pure process point of view, your accountant will essentially set up the trust for you. The servicing assessment will be done based on the directors, and we'll use your personal guarantee and your assessment to sort of contribute towards that. And yeah, once that's underway, that's essentially, hopefully down the track, once you've got a positively geared sort of property in the trust, or your trust is self-sustaining in nature, that's what then allows you to kind of keep building off the back of that. But yeah, to summarize, I'd definitely suggest, regardless, for everyone to kind of make sure you've done a thorough assessment of your portfolio, and if there's any opportunities to restructure or optimize your debt, look at the lenders, all that sort of stuff. Obviously, your broker will be able to help you with that, but that's definitely the first step.
Cool. So I suppose the only thing I'll add to that is that there are people that have established structures in the past, companies, trusts, and they understand how that works. And there's people that haven't. What I'll dispel is it is just another structure. It's just paperwork. It's just documents. And we do this every single day of the week. So it's really routine. So if a broker or Ash can give you sort of the thumbs up to go, hey, we can make the lending work inside of a trust or a company structure, the actual process to go ahead and establish it from our side is just process. We can do that pretty efficiently and pretty quickly. There's some more regulations with AML and CTF and KYC that we are under since 1 July. So there's a little bit more regulations, but outside of that, it's super easy to set up. So don't let the structure determine the investment strategy. Have the investment strategy, have the debt strategy, and the structure is just there to support that.
I think my contribution to this is probably just anecdotal. So I'm going through a big refinance process across my portfolio at the moment, taking out as much equity as my partner will allow for me to go and purchase a bunch of properties over the next 6 to 12 months. And to speak to that, I have properties in company structures, I have properties in trust structures, and I also have it in my personal name. Even though my next sort of 12 months looks very much geared towards moving away from personal structures, because that's the part of the portfolio that I happen to be in, the paperwork that I have to provide is almost the exact same, Will. So I need to be really clear on what my spending looks like. It's actually pain. I forget how much I actually hate the process of setting things up to buy property. I love the property part, but I actually hate the admin part that comes with it. So, Will, despite what you might see on Instagram, it's not some gimmick that allows you to just suddenly have unlimited borrowing capacity. You still have to be able to declare what is happening in your personal life, regardless of what structure you happen to be structured in currently. But yes, if it's part of that broader strategy, if it sort of contributes towards your long-term goals, that's where having that team around you to hopefully, strategize exactly what the next 5 years looks like, 10 years looks like, is sort of the way to go. So, Will, I hope that sort of helps. If you're on the call, I can't actually see, but if you're on the call, I hope that helps. If you have any sort of sub questions as part of that, feel free to drop it in the chat. Happy to take it from there as well. What do you think, gents? We did a good job. Should we move on to the next question?
Let's go.
Let's do it. All right. Okay, so I'm going to pick one randomly. Ben Cross. How are you, Ben? So at the moment, I'm about 38K a year, negatively geared on my property. What do you think is the best path forward to continue growing my portfolio? I think I would need something as close to neutral as possible, as I wouldn't be able to afford another negatively geared property. Now, Ben, if you're here on the call, you're obviously someone that we've worked with in the past, which is great. And actually 10 minutes before this, when I actually was going through the questions, I was like, oh shit, I should do a little bit of research. So maybe I'll kick this one off in terms of what I'm seeing from a data perspective, Ben, in terms of your particular property in Kilmore. And then I'll give you some, because I have also tackled this question in the past. I've also bought properties that were quite highly negatively geared in the right market, but they were highly negatively geared in the beginning. And I had to employ some strategies to hopefully bring them down to, manageable level so I could keep expanding the portfolio. First things first, from memory, Ben, you use your parents as guarantors. So as part of that, obviously the LVR that you were working with was, unless you contributed some yourself, your LVR is probably on the higher side. So as a result, your repayments were probably quite high, which is probably contributing to that broader 38K that you have. So I'm going to walk you through the logic of how I would think about it. I have never used guarantors in the past, but I'll walk you through the logic of how I would think about this. And there's something that Ash can definitely contribute to as well. So obviously 38K is a insane amount of money. So what I would be thinking about, like if I look at your property, I think we bought your property, it settled in December, bought it for 600,000. If I look at Kilmore broadly, as a suburb, it has done exceptionally well for you over the past 6 or 7 months, right? So if I look at what the property looks like now, give or take, it's worth probably somewhere around in the vicinity of like 650 to 660. So it's grown a fair bit, I would say double-digit percentages in the last 7 to 8 months. The reason that is important, Ben, is in another 12 months, let's say, because the market is doing really well. Vacancy rates from the point you settle to where it is now is actually halved. So the rental market is actually doing really, really well in this pocket. And the stock that you have in this suburb has also gone down dramatically in the last 7 months since you've been holding this property. What that basically means is in the next 12 months, so 18 months since you settled, I expect the market to keep rising. And I was just talking to the boys before we started this. What happens when we are in such a low sentiment market? It's not that the property market as a whole collapses. That's just not how it works. What happens is the attention turns towards the more affordable end of the market, right? If you think about it, Kilmore, I don't know, about 30, 35 kilometers from the CBD in Melbourne, it's $600,000. That is an absurd number to be able to buy in a metro Melbourne market. Ash seems to have gone into darkness. So what I would be thinking about over the next 12 months or so is what the market is doing for you, and then going back and trying to release your parents as guarantors and trying to get a better rate. So getting it under 80% LVR, getting a far better rate. I don't know what your rates look like at the moment, but repayments, I'm guessing, are a big part of that 38K chunk. So that's something that I would be thinking about. In 12 months, you should be able to hopefully bring that LVR down quite dramatically, hopefully do a refinance process with your broker, whoever you're working with, or again, reach out to Ash if you're looking for a new sort of, new set of eyes on your portfolio. And that's what I would be thinking about. And then on top of that, unless you haven't, I'm sure you've already thought about this, but things like, getting a depreciation schedule done. From memory, your property is fairly new. Get a depreciation schedule done. All right, it's only like 10 years old. So you should have building works that you could potentially put as part of your non-cash sort of tax benefits. Like I said, the rental market is stronger than it was 7 months ago, Ben. So again, I don't know when your rental review process is at the moment, but your rents should have increased because the pressure on the market is increasing. So the next rental review, I would look at increasing your rent as well. $10, $20, $30, it all contributes towards that sort of broader goal. This is something I'll let Roger speak to, but one thing that I did a few years ago, and I don't know how easy it is to do, from memory, I think because this settled 6-7 months ago, you're still having negative gearing as part of your sort of process, right? So you should still be able to retain that. Now, one thing that I did, I don't know, about 5 years ago, I didn't know this was a thing. I heard it on a podcast, talked to my accountant, and I put this in place. Instead of getting a lump sum of money at the end of the year as part of my, tax refund for, through my negative gearing for my personal properties, I actually got a tax variance done. So I was getting the benefit back on a monthly basis from memory. I've since sold a couple of properties that I was holding. So it just helps with the cash flow a bit. So tax variance is another thing, I would ask maybe Roger to speak to. And yeah, man, if I was in your shoes, man, I would just be looking at releasing your parents as guarantors. And the way you can do that is waiting for the property to sort of go up in value, getting a better rate, and that's kind of going to help contribute to that 38K deficit. So that was a lot of words, but maybe I'll pass on to you, Roger. Do you have any comments on the tax variance stuff specifically?
Yeah,
I think
absolutely.
it's something people don't speak about much.
Yeah, so it's really funny. Every single property investor that's negatively geared is entitled to do what's called a tax withholding variation. So exactly as you described it, rather than waiting till the end of the year and getting a chunky tax refund in August, July, August, September, when you do your tax return, you can actually get that refund spread out in each of your pay. So essentially, the difference between what your employer withholds as PAYG withholding and what they're supposed to withhold if they knew about the negative gearing, that difference is what the ATO makes an assessment. And they actually write to your employer's payroll office and say, instead of withholding this much, drop it down to this much, which means you get more after-tax income in your monthly pay. If you're monthly, if you're weekly, it's actually in your weekly pay. So it just depends on whatever your pay frequency is. You just get more tax dollars, more dollars after reducing the tax periodically. So it makes a massive difference for cash flow. And when I bought my first investment property in 2000 and whatever, 16, 17 years ago, I did the exact same thing because, I was a graduate and I didn't have very much money. So every bit of cash flow to help service the debt made a big difference. So absolutely speak to your accountant to do it. So essentially the process that we undertake to do that for you is effectively we kind of pre-lodge an estimated tax return with the negative gearing in it. So the tax office looks at that and they go, okay, that's how much tax you're going to be up for. So they'll just tell your employer withhold only this much tax.
Yeah. And I think we, like 10 minutes ago, we were talking about strategy, right? So Ben, if you're on the call or anyone else who's on the call, this is kind of what strategy is, right? This is how we plan out meticulously how things work in your particular circumstances. So this is how we approach what strategy is, right? Strategy is like the buzzword, I think, that gets thrown around a lot. But this is a very good example of what strategy looks like. The different levers that we can employ to hopefully get you in a position to keep building the portfolio if that's what's within your remit. Sometimes the answer is, hey, man, you can't actually build a portfolio for another 2 years. And that's okay. But it's good to know that upfront rather than sort of, getting drawn into the things that you see on Instagram to be like, oh, I also want to build a $30 million portfolio tomorrow. It doesn't always work that way, but there are levers that you can have. Like I can guarantee you 50% of the people on the audience probably don't know that there was a tax withholding variation thing that you could do with the ATO. So these are like these little small things that you can learn working with the, likes of Roger and Ash. And yeah, your life becomes very, very different. And the other thing that I would think about as well, Ben, if I was in your shoes, is a little bit more like sort of outside the box, right? So one of the things that I used to do back in the day when I used to have a PPOR, I've let go of that now and went back to rent vesting, was actually rented out a couple of rooms of my house. Now, obviously, this is an investment property for you, right? But is there an opportunity to do that? Do you have the opportunity to potentially rent out room by room, right? It's just, I'm not saying it is possible. I'm saying think outside the box a little bit on how you can increase your income. Because really to help with the deficit, or whether it's 38K or 40K or 10K, you really have two levers. You either increase the income, and the only income that you get from an investment property is rent. You either find a way to increase that through whatever the rental market is allowing you to do, or you can reduce your cost, right? There's really the only two things that you can do. So if you think outside the box a little bit, these are sort of some of the things that are at your disposal over the next 6 to 12 months to be able to, hopefully make your life a little bit easier. So Ben, if you're here with us, man, hopefully that helps. Cool. Gents, happy with that answer? You guys good to move to the next one?
Let's do it.
Beautiful.
Let's do it.
All right. Who do I throw under the bus next? All right. Let's start with... Ross had some really good questions. This one is going to be... There's a few different parts to this question. So this one might be a Roger and Ash thing. Existing properties in trusts, negatively geared. Hold/move to another structure/sell. For new purchases, which structure, personal trust or PTY Ltd? Should you be releasing equity against properties held in personal name, maintained negative gearing, rather than releasing it into the PTY Ltd trust/trust, where the next property is going to be purchased within? Number 4, what gross yield should investors be looking for to mitigate risk of potential slowed capital growth with the recent taxation changes? There's a bit to that. So I'm just going to hand it straight to you. That's a chunky one, yeah. There's probably a broader answer there, but maybe, Raj, we'll start with you if you have any early thoughts on the question.
Sure. So really the first question, which is existing properties in trusts that are negatively geared, should I hold it or move it into another structure or sell? That's a multifaceted question. So it's a structuring question, right? So if you were to restructure into another structure, the question is, what is that other structure? It's no longer going to be an SMSF. So the question is it a company or your personal name? And we just know from the previous conversation, when you max out your personal borrowing capacity, you're kind of limited for future investment, right? So it sounds like you're an ambitious investor. So then the question is should I move it to a company? And you've also got in there to sell. So if you transfer it between a trust to a company, that is effectively selling it, right? And then the company is going to have to then pay stamp duty on the acquisition, and you're going to pay capital gains tax on that. So you just have to really look at, well, what is it going to achieve? Often when you already have an existing structure in place, it's too costly and not really, the incentives aren't there to undertake a restructure. So I don't know how much capital gain you've built in or maybe loss you've built into those properties that you're currently holding. But instinctively, my response is you're probably going to hold that one through its investment cycle till the right time is to sell it. So then the question, is it the right time to sell? It's probably a question more around the properties that you hold, and probably speak to an RD or speak to someone who's an expert in that space to understand, is this the right time to exit out of that property? Is it meeting the investment strategy? I think I've answered the hold, sell, or move into another structure. The second question, for the new purchase, which structure, personal trust or proprietary limited? So this is a question we're getting asked a lot because of the budget changes and things like that. So in the past, we used to consider, trust used to almost be the go-to in the past for most property investors because it allowed you to stream capital gains, which means that if you had a capital gain in the trust, you could divvy it up between people that are potential beneficiaries in the trust and overall reduce the tax bill. And the other benefit of the trust is the fact that you could apply the CGT discount at the beneficiary level. So if you stream it to an individual, you can still get the 50% CGT discount. So now that world is gone, then you look at what the company tax rate is, and then you look at what the highest marginal tax rate is for an individual, which is up to 47%. So you go 30%, 47%, long-term capital gains, doesn't matter whether you hold it for 6 months or 3 years, it's going to be the same tax rate. So then companies are starting to look more and more attractive nowadays because you can cap the tax rate at 30%. You can retain the earnings if you're looking to then redeploy that into another investment. And then because of the franking system, you can actually keep the tax credit and then draw it out in the future and get the tax credit down the track, right? So right now, if you're asking what is kind of a bit more of an optimized structure for investing, the good old company is definitely ranking up number one. So that's probably my answer for that. Without looking at your specific circumstances, that's probably what I'd say. Should you be releasing equity against properties? That's probably a Ash question.
What's the question again? Should you be releasing equity against properties held in personal name, maintain negative gearing, rather than releasing it into PTY Ltd with a trust where the next property is going to be purchased within. Yeah, look, from a lending point of view, a lot of my clients, and it kind of makes sense in most instances right now, are just, cashing out as much equity as they can. And if your property is negatively geared, that's the benefit you can obviously accrue. Now, and again, this might go back to you, Roger, from an accountant point of view, but look, if you're looking at purchasing another property down the track in a trust or a company, I mean, you can obviously use the equity that you extract from your property that's in your personal name and use that as the deposit for the purchase. The borrowing for that new purchase is going to be in the trust or a company, so that's separate. You've got the equity that you've cashed out from one of your existing properties that's in your personal name. That is tax deductible, right? So you'd still be able to get the benefit from a negative gearing point of view. So yes, it does make sense to do it that way. That way you can obviously kind of, kill two birds with the one stone, and says that you still continue getting the most of your negative gearing. You've got the equity that you can cash out from one of your existing properties in your personal name, and then look at the future lending through a trust or a company, whatever is advised by your accountant.
Yep. So what I'd say to that is, if you are going to do an equity release against one security or one property, and then you're going to take the equity release and put it into a trust or a company, split the loan. Make sure you have a very distinctive split. So it's very easy to track, okay, that money was a borrowing for that investment. So we can connect the borrowing against the income producing purposes from a tax perspective. But absolutely, it's pretty common to do an equity release from one property in a structure personally or whatever, and then use it to purchase another one. Yeah. So the final question, what gross yield should investors be looking for to mitigate risk of potential slowed capital growth with the recent taxation changes? This is like a multifaceted question, and this is almost like a mathematical question, right?
It is.
So if you can marry up your yield against your holding costs, then you're in a great world, right? Where then you're neutrally geared. The tax changes is not what's going to determine, I think, the yield that you're trying to chase. I think it's the investment strategy that's going to probably determine. So, Artie, can I hand this over to you?
Yeah, man. Yeah. I think it's a good question, but yeah, it is multifaceted in a lot of ways, right? Because it implies that there is a slowed capital growth that happens as a direct result of a couple of legislation changes. So again, it sort of goes back to what I was saying in the beginning. It depends on the market. So Ross, if you are the Ross that I'm thinking of, you've bought in markets with us, which have some great sort of tailwinds behind them, right? The Tassies of the world, the apartments that you're now exploring as well as part of your next steps. They come with some great yields to begin with, but they also have some great fundamentals that are going to work with them, work in their favor, regardless of what is happening in the broader macro market. Purely, maybe it's a little bit slower than what it would have been if it was a little bit more bullish, but because you're on the affordable end of the market, the next 12 to 18 months is going to look quite great for the average punter who's getting into some of these markets. So I think there's an underlying question there around how do I actually manage my sort of holding costs and how do I manage my cash flow? I try not to get into investments that are sort of, really, really negatively geared, right? That's just part of my investment strategy. I don't want to be reliant too much on any active income that I drive in order to be able to hold property. So for me, if I was you, Ross, as you sort of keep expanding your portfolio, I'll be thinking about, okay, with the Melbourne apartments that you're exploring with the team, what kind of yield should I be getting so I can manage my holding costs a little bit better? Because you're obviously releasing a bunch of equity as well. Your repayments are going to go up. What kind of holding costs can I actually manage in order to be able to, keep expanding that portfolio? Which kind of goes back to Ben's original question around how do I manage my deficit that I have at the moment and start thinking a little bit more broadly. So the investments, the investment strategy that sort of Roger keeps mentioning, on most of these questions, it really becomes key. What is your long-term plan? Are you planning to purchase more property in the next 5 to 10 years? Do you want to keep expanding your portfolio? I don't think there's a specific number that you should be driving towards. It's not like, I need to be getting 4.23% gross yields. That's not the point. It's about what it looks like holistically for you, because it's different for you as it is for me, as it is for Roger, as it is for Ash, right? So work with the people who are in your corner, your brokers, your accountants, your buyer's agents, to figure out what that sort of piece looks like. and it's all sort of reverse engineered from what you're trying to get to. And I think is a bit of a non-committal answer, but that's probably the best you can get in a forum like this. There's probably no other crystal clear answer around that. And comes back to Roger's point. It is a mathematical question more than anything else. But I definitely don't want you to walk away from this thinking that a couple of legislation changes is what's going to drive the property market to potentially tank. Just not how it works. We've had far worse things in the past. Roger?
Addy, I want to share an anecdote. So we've got clients. So we look after over 5,000 clients around Australia, right? So we've got clients in every stage of their wealth building, investment life cycle, from first job to retirees, right? And those that is smart money, people that have accumulated good amount of wealth, they are looking at this time in the market and they're going, excellent, right? They're doing the Mr. Burns excellent because they are going, this is where we're getting bargains, right? Because there is a lot of bargains in the market because of the general overarching market sentiment. So if smart money is looking aggressively in the market right now, you can imagine that, there is no right or wrong time to buy. So you can't go off prevailing market sentiment. And prior to us jumping on the call live with the audience, we were just talking about the macro market and we're talking about the sub markets. People look at the headlines and they go, this is what's happening in the market, but that's not really truth, right? You can't make these overarching statements about the entire market because it's not necessarily accurate when you look at all the sub markets that sit underneath. So one of the things that we were talking about is properties that are on the higher end, like the more expensive properties, they obviously take a much harder hit during times of compression, right? So like, the $2+ million properties, they're going to drop a lot more. And then if you factor in those big drops in the market values, of course, it's going to look like the whole market is crashing. But those that are in these markets that are in the affordable segment, like Artie and the team have been, doing the research in, those are the markets where people are going to flock to. Hey, I can't afford these bigger, my borrowing capacity's dropped, but I can still afford $600,000, $700,000, $800,000 a year. So those markets are going to have more demand and they're going to start picking up some momentum in terms of pricing. So I think it really depends on what your investment strategy is.
That's really good. And I think probably leads into sorry, Ash, you were going to say something?
No, all good. I mean, look, the quick point I was going to make is, again, cash flow is just so important, right? So just while we're talking about all things mathematically being thought through and being very analytical about the whole thing, that is so important because, again, particularly at the early stages of your portfolio, when you're in that accumulation phase, that is when it's going to be really tough, right? And again, with property, it's all about time in the market. And so the thing you've got to try and make sure that you can do is, how do you sustain those initial years, right? Like, that's when the cash flow is going to be the hardest. That's where your negative gearing is going to be the hardest. So as a really good practice that I always do with all my clients, and I think everyone should make sure they do it to a certain extent, is just look at those buffers, right? Again, make sure you kind of plan for that additional increase in the rates. Make sure you plan for things going wrong with your property maintenance, this, that, or the other. Because again, it's those investors who have those strong fundamentals are the ones who will be able to outlive these property downturns, and whether it's 1, 2, or 3. And again, your cash flow and your buffers are super important for that. You can be an extremely aggressive investor and go and buy a whole heap of properties in this downturn. But again, if you don't have the buffers and if you don't have that solid sort of foundation, come the next downturn and you'll be forced to sell because you can't sustain it, right? So then just kind of thinking it through in that sense is really important.
Yeah. Really, really good. And I think it probably leans well into Danuka's next question, which sort of kind of encapsulates everything that we're talking about here. With the apparent downturn in the market currently, what is your recommended target dwellings and approximate locations that you would encourage investors to look at? So Dukes, good to hear from you, man. Hope Jakarta is treating you well, sir. I think the main thing you want to take away from this, Dukes, is there is no market, man. There is no one big market. Australia is divided into quite literally hundreds and thousands of sub-markets, right? So what Roger said before, there are segments of the market that are going to be hit the hardest as part of the sentiment issue that we're having in the country. Like if you look at Toorak has had, everyone wants to buy property in Toorak, right? Which is probably one of the most premium suburbs in Melbourne. But Toorak has been hit one of the hardest ways over the past 12 to 18 months. So if you look at Toorak in isolation and you look at what has happened in terms of a percentage change in its dwelling values, it has been awful. But in the same time, you've had the Frankstons of the world or the Meltons of the world that have gone up 12, 15, 20%. So you do a quick comparison between the two and you're like, okay, the affordable end of the market end where almost anyone can really reach, versus the end that no one can really reach. It's a very small percentage of the population that can reach it. So that's where your sort of thinking needs to be. It's not a broader sort of the entire market is shit. That's just not how the sort of property market works. It's about which segment of the market that you're actually focusing on. So if I was in your place, right? So from memory, you had I think like a block of units or something in Clayton. Sorry, it's been a long time. I'm just going back into my memory recesses. I think you had like a really great sort of student accommodation or something in Clayton. That's a great asset to hold. It's good cash flow. You've had it for a while. And, the sort of the unit complex, the unit segment of the market in Melbourne is going to start to move because property prices have moved so dramatically in some of these areas that it's become almost unaffordable for the local residents, right? So you just have to I guess, broaden your thinking a little bit and start focusing on the markets that you've done some research into and be like, okay, this is now affordable at a ground level. And that then becomes part of my next sort of portfolio building. So again, I wouldn't be thinking about it broadly, that there's a broad downturn. If you, again, look at things at an aggregate level, you will always find there's a downturn. Almost always, right? Melbourne always looks like it's doing terribly at an aggregate level. But aggregate means you've added up all of the different purchase prices. Now, of course, if the premium end of the market is struggling, that is going to bring that aggregate number down. That's why the Cotality reports always look at Melbourne and Sydney in a really poor way. But there are parts of Sydney that are also surging in prices, which no one really speaks about. But if you look at Sydney and broadly, and you look at Vaucluse and you look at all these, Rose Bay and all of these markets, of course they're struggling. They're $5, $10, $15 million markets. At a time where interest rates are what they are, there are very few people who are going and investing into those markets. So go back to the fundamentals, Dukes. Look at, undersupplied, chronically undersupplied, affordable, high demand markets, and you're going to come out doing pretty well. And this probably leans well into the next question. I think I saw a question from Brendan. How are you, Brendan? Hope you're well, man. Next growth hotspot. So look, we've obviously spoken about many different markets at Alaya. I do so on the podcast. I do so, through the different mediums that we have. There are a couple of markets that we haven't really spoken about broadly because the research hasn't been finished. My team's been focusing on sort of, finalizing the SMSF deals, but we are finalizing some research that we'll release in the next month or so about some markets that have really not been touched over the last 5 or 6 years that I'm quite excited about. So I won't go into the specific details, but again, it just goes back to fundamentals. Roger, did you have anything you wanted to add to, I guess, the broader story around dwellings and locations and, I guess, how to think about things?
But I think you've hit most of it. So, like, I was having a practical conversation with one of my clients that's accumulated a sizable portfolio, 20 mil odd, but all blue chip properties. Average, most of those properties sort of 2 to 3 mil in value. And she's talking about how she's having a tough time trying to dispose of some of her properties. And she's like, yeah, I had to take a $200,000 less than my expectation on this particular property. And she was obviously moaning about that. But in the fullness of her entire portfolio, she's done exceptionally well, right? So the properties are always going to perform differently in different markets. But if it's fundamentally a good property and the fundamentals of that property, the location, the access to amenity, transport, all that sort of stuff still stack up in the initial selection of the property. Even if there's changes based on macro factors, it's still going to be a sought after property. There's still going to be a buyer demand for that property. The only other thing which we didn't really touch on earlier, because we've talked a fair bit about like investment strategy and stuff like that. I suppose being an accountant, the clients will often talk to us about different things going on in their life, marriage, divorce, whatever, like the whole cycle, right? So one of the things which I suppose I'll also speak about from my own personal experience is there is the investment strategy, but there's also like, what is your life goals, right? So you might be aggressively accumulating and then you might find your life partner and they might want to buy a home and settle down. So all of a sudden you're highly geared. And then, is that going to impact this goal, which is an emotional goal or a personal goal? And then we see people that go through like accumulation and then they go through sell down to then buy the family home, right? So I think you've got to look at the investment strategy, but you also have to overlay that with what is your life plan and life strategy as well, and making sure that they mingle and integrate well. Because what you don't want to do is aggressively go down one path with a financial view or an investment view, but that may be at odds with maybe something which is a little bit more personal. Where do I want to send my kids to school? Where do I want to settle down? Do I want to buy the family home? Is my partner happy with rent vesting? Because some partners are not. Some people are like, we have to own our family home. So there's a little bit more things to consider when you're looking at that holistic strategy as well.
Really good point. Anything you wanted to add to that, Ash?
No, I think you guys covered it really well. Yep.
Beautiful. Why don't we move on to, we're running a little bit short on time, so why don't we move on to the next question? I think all of us would love to speak to this a little bit. What is the next big driver for the property market in Australia for the next 5 to 10 years? It's obviously a broad question. It's probably a little bit of a loaded question as well. We've probably touched on it fragmentedly across all the other answers, but why don't I start with you, Ash? What are your thoughts, man? What do you think are the next big drivers? Are you bullish? Maybe we start there. Are you bullish about it, or are you bearish about the Australian property market in the next 10 years?
Nah, look, absolutely bullish. And I think, look, it's not just me and my opinions. I mean, you just have to look at the facts, right? So and I know Alaya has done amazing work, and I know Adi, your team's going to share that off the back of this session as well. But there's amazing data and sort of research that you guys have pulled together that kind of puts everything into perspective, right? So, Roger, I'm going to steal one of your quotes that you sent through in one of those emails the other day, where you don't know you're in a cycle until you zoom out, or something on the lines about, right? So look, I think that perspective is just so important. And I think once you see that additional research and data that the Alaya team have pulled together, again, it'll give you some really, really good context to sort of appreciate what we're going through and how do you kind of look at the future. I'm just absolutely bullish, mate. I mean, if you look at those fundamentals, and I know we've touched on them before, and this is probably more your domain anyway, Adi, but I mean, there's such a significant shortage of supply, right? And again, that's a structural issue. It's not something that's going to change anytime soon. So I think if you've got that, and we're facing that for the foreseeable future, there's only one way where rents can go, and the rents are going to go high and increase. And again, that's going to help with your yields. And again, it's all about sustaining through this tough period. But again, the longer you can sustain, given that shortage that we've got, which is a chronic structural shortage, that's obviously going to help. And again, that's also going to help property prices. I mean, you look at the population growth, and yes, I think that the numbers have sort of, and I'm sure, Adi, you've got the numbers with you. Like the numbers are still significantly skewed in terms of net intake of migrants coming in, right? And again, that's not necessarily changing anytime soon either. If you look at infrastructure spending, our government loves spending on infrastructure, which isn't great for inflation. But when it comes to, again, looking at infrastructure that supports property prices and growth in certain areas, that's obviously going to be really, really helpful for a lot of properties in a lot of areas. And look, I mean, I'd probably say, again, when you think about cycles, like we're in a cycle, and one of the reasons for that cycle is also the interest rates having gone up in these last few months, right? So when you look at the macro tax and sort of policy environment as well, there will be another cycle where the interest rates are going to go down. And I think, that might be sooner than some people potentially anticipate, potentially in 2027. But again, the point being that the prices go up, prices go down, interest rates go up, interest rates go down. If you're looking at assessing property and whether it's worth investing in over a very short period, you'll kind of obviously face into all these questions and all these roadblocks. But if you're looking at it over a longer period, which is what you should be doing, whether that's 10, 15, 20 plus years, looking at over the last few decades, there's only one answer. And, and again, the data sort of supports that. So I'm super bullish. I think, again, just focus on the fundamentals, both from an asset selection point of view, but again, focus on the fundamentals for your lending and your lending arrangements and your what the finance that supports your property, because again, it's all about finance is the name of the game, right? So make sure you're focusing on those fundamentals, and I firmly believe you can't go wrong.
Yeah, I think bang on, man. The question I like to ask myself in all of this, right, with the sort of short-term downturns that we have, if I was to look back in 2026 through the lens of like 2036 or 2040, do I think in my heart, right, if you take out all the objective data out of it, do I think property is going to be worth more in 10 to 15 years than it is right now? If you were sitting in 2016 and you were going through the same sort of thing, it's like, oh man, the Royal Commission is coming in, the sentiment has changed, and suddenly all of these like new policies have come in, borrowing has become really hard. People were terrified in 2017. You know when people were also terrified? In 2008, when the GFC was happening and the world seemed to be falling apart. People were also terrified in the 80s when CGT was suddenly introduced, when CGT was never a thing, or in the 90s when there was 17% interest rates. In hindsight, though, you think the people that bought property in those 80s, the 90s to the 2000s, the 2010s, do you think they're better off objectively today in 2026 than they were at the point of purchasing the property? So that's the question you have to ask yourself. Do you genuinely believe that property is going to be more expensive? And then when you look at the underlying data, it's exactly what Ash said. We are chronically undersupplied. We are running so far behind this absurd 1.2 million home that they were meant to build by 2030. We're hundreds of thousands of homes behind already. We're still letting people into this country, which is amazing because it's a beautiful country to live in. Everyone wants to live in Australia, right? So the net migration growth, the net population growth, we're at what, 27.5 million already, right? We're increasing population. So if you were to buy a good asset with great fundamentals in a, not in some, backwater town, but in a hopefully like a metro area or a really big regional area, do you believe that $500,000, $600,000, $700,000 asset is going to increase in value in the next 10 years? If it is, and if you can get your fundamentals correct, you can manage your buffers, you can manage your cash flow, you can do all of the individual level things, then I think there's only one answer, right? It's not about being bullish or bearish even. It's just facts, right? Do you think your property is going to be worth more in 10 years? So that's the lens through which I look at it. So I'm going through the same process. I haven't bought property in about 12 months, but I am now in the market. Alaya's a little bit more established now. I'm now taking a lot of the equity that my partner and I have built over the last, 10 odd years of investing, and we're going into the market. Now, will I see downturns in the next 20 years that I'll hold this property? Of course I will. But it doesn't change my investment thesis. It's the same with shares as well, to be honest. You don't just have to look at sort of the asset class of property. Do you believe shares are going to be worth more in 20 years? So it comes back to your investment strategy as a whole. Tax changes and, governments come and go, elections come and go. Who knows? We might have Pauline Hanson in 2 years. It's a scary world we're living in, right? So it's just, your actions today can't be driven by things that are completely outside of your control. Look at the fundamentals, look at what is happening within your control, and then make a decision around it. And if you feel after all of that holding cash is your best bet, knowing what inflation is, knowing how expensive things are, knowing that $100 an Aldi today or Woolworths today gets you far less than it did 5 years ago. If you think that is the best outcome for you, then so be it. But at least it's an informed decision. So that is sort of like the lens through which I sort of look at things. And yeah, hopefully, Kamasan, that sort of helps, man. It's a bit of a broader answer from the group, but hopefully that helps.
I've got a couple of points that I might add to that specific question that we didn't quite touch on.
Sure.
Because we've got a lot of clients that are in the building and construction space, right?
Yes.
So they are plumbers, carpenters, all sorts of trades that sit in that space. We look at their P&Ls. We see their costing, we see their revenue increases, we see their cost increases. And then there's also my own personal experience with doing developments and stuff like that. So the raw cost of what goes into building a house is also subject to inflation, right? Materials go up, things go up. So often there's so much properties that are on the market right now that you wouldn't be able to replace that with the same amount of cost it is to buy the property and the land that sits underneath it. So the sheer fact that there's a lot of properties that it'll cost more money to buy it than to build it than to just buy it as is going to put an upwards pressure on pricing, right? Because you just can't replace it for what it is. So replacement cost is definitely one. And the other thing as well, which is a massive macro thing, is that the baby boomers, right? There's going to be this massive wealth transfer. And what I have observed with money is when money comes into a bank account, it normally wants to go somewhere. It wants to go into assets. It wants to go into property. It wants to go into shares. It wants to go into investments. People seldom keep money lazy lying around, right? So if you inherit money from a baby boomer because you're lucky enough to have wealthy grandparents, or maybe they're sitting on a $3 million house with zero debt, that money will end up going somewhere. And one of those places is property, right? So they'll get inherited and they'll probably end up in property. So because the wealth transfer is in the trillions, as I'm told, it's a huge amount of money that's transferring, and there's a huge amount of money that's getting unlocked out of super as well. Some of that money will go towards lending the next generation a hand to get into the property market. So people that you might be competing with, you might be competing with a 21-year-old that's had their parents that have just retired and they've gotten cash out of their super funds to hand, right? So that's going to go into property. So there's the wealth transfer, there's the pure replacement cost. And Adi, I'm sure, and you as well, Ash, I'm sure you're seeing a lot of these guarantor loans happening that probably wouldn't be as high as they were 10, 15, 20 years ago. And that is an indication of the previous generation lending a hand to the next generation to get into the market. And I predict that'll keep increasing. More guarantor loans to help the next generation get into the property market. So I think these are some big macro things that in the next 10 years will have a massive impact on keep supporting the narrative that property will continue to increase in price.
That's good, man. I love that. I forgot about the construction cost piece. Like, I mean, if you look at even the macro environment, right? What is happening overseas with, the Strait of Hormuz and stuff? I don't want to get into the political landscape, but all of that has a, upward pressure in Australia as well. Because diesel, right? If you look at diesel is a huge part of the construction industry. Bitumen, all of the shit that you have to make as part of, building a new estate, diesel plays a huge role. So when diesel goes through the roof because, whatever's happening overseas, that has a real pressure. Do you know how many builders are now going out of business because they simply cannot afford to, lock into the contracts and these are fixed contracts, by the way, so they can't even increase their prices. A lot of these builders have fixed contracts in place for things that they committed to maybe 12 months ago, even though the landscape looks completely different now. Their cost incurred, so do the same thing that they did 12 months ago, has gone up like 20, 30%, but they have no choice. They can't they can't pass the costs on. So a lot of builders are going out of business as well. Like compared to what it was pre-COVID to where we are now, I mean, some of the percentages I've seen is ridiculous. That industry has been impacted so severely. So the very people, the very trades that are going to build the houses, they are going under, right? Because it's so expensive to build houses now. So if you're picking up something, again, if you just think about it logically, if you're picking up something with a, 500, 600, 700 square meter block, and you fast forward 10, 15, 20 years, do you genuinely think that piece of land is not going to be worth at least, twice as much as it is today, especially if you're buying it at, 600, 700K in 2026. So these are some of the sort of logical frameworks that I tend to think through. And I think, Roger, you sort of hit the nail on the head. Around the wealth transfer as well, because there's a lot of wealthy people out there. They have to put their money somewhere, and it usually goes to the kids, and the kids usually go and end up purchasing a bunch of property as well. So, lot of factors I think working in our favor. Having said that, there is always going to be small micro sort of periods where you are going to see where you're going to see corrections. We're going to see corrections with Perth. Perth was the darling child of Australia for the better part of 4 years. We're now going to see corrections in Perth, and suddenly people's attention is going to be like, oh, wow, Perth sucks. Perth doesn't suck. Perth has just gone through its cycle, right? That's just what property is. So very, very easy to get sucked into moments, but much easier, much harder to just zoom out, look at it holistically. If you jump on our page and go to the, cost of waiting side or, what property history has looked like over the past 55 years, you'll see a very clear correlation to what long-term holding looks like to, what short-term sort of, corrections look like. So hopefully that helps. I think we've covered most of it, but I do want to get into this one. This will probably be our last question for the day, just so we don't hold the audience for too long. And I actually love this question. And I think all of us can probably contribute to it to some degree from different angles. This comes from Peter. Hey, Peter. Hope you're well, man. Interested in the panel's thoughts and opinions on how your portfolio and the residential assets you hold should change over time. Say you have $2 million, $5 million, $10 million, $20 million portfolio size. What have you seen from experienced, successful investors? Do they typically reduce the quantity but increase the quality of the assets, reduce flexibility for increased peace of mind, and less effort to maintain the portfolio? That's the theme I'm touching on. Going through a rough patch where everything that could go wrong is going wrong with a few of my lower quality properties. Thanks, guys. I actually really like this question. This is a brilliant question. I think there's so many different facets to it. Maybe, Roger, maybe we can start with you, man. You obviously just spoke about someone who holds $20 million plus. So you're already seeing a lot of that wealth accumulation. It sounds like she opted for the blue chip end of the market. But what are you seeing, man, as people sort of go through that journey?
Yeah, absolutely. So when you're, say, 2 million property size, like you're in the early stages of accumulation, right? And then the other end of the spectrum in your question, 20 million, you're at a more like larger scale of portfolio size. So the things that we see is, how do we minimize the holding costs, right? Because you can't be severely negatively geared at a $20 million property portfolio unless your income is enormous, right? So as you start progressing, as many of the questions that have come through have asked about, like, what do I do once I start capping out in borrowing capacity and things like that? You do need to start having portfolios that have got income generation in there as well, that are positively geared. So either your LVRs are reducing or your yields are increasing, or your asset classes might need to modify to say maybe commercial as well. So what we see is a lot of people accumulate their wealth in residential. At some point in time, then they start pivoting to something that looks more like a commercial with higher yield. So that might be a block of units where you might have a single title, but you might own all 10 in it. So that's kind of, it's still residential, but it's kind of pseudo a commercial type of asset. And then people start pivoting into like light industrial, factory, office building. And we see the full spectrum. And we're fortunate in the sense that we also run a property fund as well, and we buy big commercial assets. Our last one we bought was a big office block for $30 million. And the investors, so, we obviously know the investors because they're our clients as well. So those are people that have accumulated wealth in other sources, and then they're buying commercial assets, which is low touch, lower risk, high yield. So their money is more protected, and it's less involvement from them to actually generate the returns that they're looking for. So I suppose the short answer is it evolves as your portfolio evolves, and your exposure to debt also changes because your actual capacity changes, and then your risk profile also changes. Like if you've got 20 million in property, not a lot of people are comfortable having $10 million in debt. You know what I mean? Or 15 million or $18 million in debt, right? So your appetite changes for debt as well as your portfolio size increases. I don't know if that kind of answers the question.
I think so, man. Look, from my perspective, the other thing I'll mention is that, the industry has evolved in such a way. We have so many people out there that are like, I don't know, saying I have a 200 property portfolio. Personally, I can't think of anything worse. Why in the hell would I want to hold 200 properties? Can you imagine the how much taxing it happens on your brain? Like the amount of paperwork and the amount of admin that you'd have to go through. So I think as you become a more sophisticated investor, you just start thinking about things a little bit more differently. You've just held through 10, 15 years of holding maybe 10 properties, and you're like, I don't necessarily want to go buy another 10. Now it's about my net worth, right? I want to be buying better quality assets. I want to be thinking about it a bit more holistically. If I can accumulate $2 million worth of assets with 2 properties versus 5 when I was, a graduate maybe, I start thinking about things a little bit differently. But this is where the holistic strategy comes in as well, Peter. And I know you do this really, really well, having worked with you for a little while now, is start thinking about things like, what can I do to generate income on the property? That's where the granny flat conversation comes in as well. Can I start thinking about things like that? Can I look at things like rooming houses for my next investment as part of that cash flow play? I still want the benefit of having a residential asset because that gives me the capital growth, and I want the land component that goes with it. But maybe I need something a bit more higher yielding. That's where you start thinking outside the box. And I know that's something that I'm doing. So my next few purchases will be blocks of units, exactly what Roger spoke to, because I am looking to capitalize on, what I'm bullish on, which is the broader Melbourne unit apartment market. But I also want a richer asset, which is not an accumulation of 6 different assets. I want an asset with maybe 3 or 4 units in there. So I'm thinking about things a little bit differently rather than picking up like individual, because that's just the phase of my investing journey I happen to be in. So I think your thinking around investing evolves as you become more and more sophisticated, as you go through periods of I've also had Peter. I've had years where I've had like $30,000 worth of repairs, and I'm like, this sucks. Property investment sucks. I don't want to do any of this. And then suddenly you see the value that comes out of it, and you're like, okay, maybe this is okay again. But it is a painful process to go through. So, and that's not to say that if you buy better quality asset that you're not going to see any repairs, right? You're also going to see that. It's just, again, it's just about how your thinking evolves as you sort of become more and more mature in the market. So that's probably my perspective. It's a bit of a, I guess, broader perspective, Peter. But I definitely would encourage you to not think about, some of the influencers out there talking about their 200 property portfolio. That really shouldn't be anyone's, target. It's more about the total net worth. That's more of a, like a speaking point for them. And it's something that they like talking about on podcasts, not necessarily something that is pragmatic and, getting you to your long-term goals.